Corporate finance presentation. Financing with common stock and preferred stock overview. Get ready, it's time to take our chance with corporate finance. Financing with common stock and preferred stock. Remember that when we're thinking about the financing of a corporation, we can break it up into two primary categories, two primary buckets, that being debt financing and equity financing. On the equity financing side of things, we can break that up into two primary categories, that being common stock and preferred stock. The common stock being the general thing that we think about when we think about the equity financing. Preferred stock being another component, it having pieces of it that are similar in nature to debt financing and some similar to the equity financing. We can imagine then the company itself issuing the securities and then receiving the cash for the issuance. This is similar to when you think about the common stock type of issuance, for example, similar to a sole proprietorship or an owner taking their own personal money, putting it into the organization, increasing the equity side of the organization and of course the assets of the organization going up as well. No real impact on the income statement, the performance side of things. So let's first take a look at the common stock. It represents the company ownership. So when we're thinking about the common stock, those are what we think of as the owners of the company. Now, when you're thinking about a large type of company, like a publicly traded type of company, you can think of it similar to as a democracy kind of situation, a republic. We have the stockholders vote for the board, typically the board who hires management, and the management controls the day-to-day kind of business type of activities. So in that situation, you have the voting power for control, so that you can then have control over possibly the decision-making process on who to hire possibly, and then who to hire can then be purchased or then decide who is going to manage and make the day-to-day business decisions. That's going to be in a large type of organizations. You can have similar structures as the organization is smaller when you're talking about non-publicly traded type of organizations as well, but similar type of ideas, similar type of structure, common stockholders being thought of course, as the owner. Preferred stock, on the other hand, is a secondary source of financing for a corporation. It has features of both debt and common stock securities. So it in some sense is going to be similar to the debt securities in that the amount of the return generally is more secure, because usually the dividends have to be paid to the preferred stockholders before they can be paid to the common stockholders. And if they're not paid to the preferred stockholders, then they could accumulate upwards. However, also there's going to be a set limit generally to the amount that needs to be paid to the preferred stockholders. Therefore, as the company does better, they're not going to increase the amount of payment to the preferred stockholders. But if things go down or go poorly, then the preferred stockholders are typically going to have priority over the dividends that will be received before the common stockholders. So when you think about the relationship between these two things, these two types of securities from an investment side, if things are going poorly, then if the income is down, for example, you might want to be on the preferred stock side of things because you're more likely to get paid. However, if things go up and things are doing well, then you'd probably want to be on the common stock side of things because the value of the stock itself would be increasing. And if the dividends increase, you can have an increasing amount of the dividends, whereas again, the preferred stock will typically cap out on the amount that would be required by the dividends on a yearly basis. They don't have ownership interest in the company, so they're not considered to basically be the owners of the company. But note what's different from the debt, so you can see how that payment process is similar to debt. When you think about a bond, you think about fixed interest payments. You think about the bond having more security in the event of a problem, of a downturn, as opposed to the common stock, which are the last people that get paid, kind of similar to a business type of situation. If you're the owner, you have to pay off the liabilities first before you get the benefits. And if things go well, then there's a cap to the amount of payments. The thing that's a little bit different on the preferred stock, of course, from the debt side of things, is you don't have that termination, that maturity date that you would have on the bonds. And that's going to be something that would be similar to the common stock in the equity side of things. Also, when you get paid from the preferred stock, it's in the form of dividends, preferred stock dividends, an equity type of thing, instead of from a debt type of situation, which it would be interest. If it were interest that is being paid on the debt side, you also have that tax component involved on that as well. So they have priority claims on the dividends as well. So common stockholder rights. So if we're thinking about the common stockholders, the owners in essence of the company, they have a residual claim to the company income. They have voting rights, and they have the right to buy new shares. So we're going to go over these three in a bit more detail, one by one. They have a claim to income. So whether they receive dividends or not, common shareholders have a residual claim to income. So in other words, note they have the voting power, and so they have some kind of control over what happens in the company, but it's usually going to be a step away. It's not direct control unless it's a non-publicly traded company, right? They have a step away where they hire the board of directors. The board of directors hires management. So they have some control, but it's not direct control, or may not be direct control. So they might not have the ability to basically have the company issue dividends at will. This is different than if you're talking about a sole proprietorship or, say, a partnership, in which case, if you want to draw money out, you can decide yourselves to draw money out and pull money out and possibly change it to different draws that would go to different people in a partnership. You can't do that so much in a corporation, because the idea of the corporation is that all the shares are the same. So if you make a determination that there has to be a payment going out to the owners, the shareholders, then you're more restricted. You got to get everyone, the dividends. So everybody has to kind of agree. In essence, there has to be some agreement in terms of what dividends are going out, and they have to go out in conformity with the rules and have some kind of general uniformity generally over certain classes of the common stock. But even if a dividend is not issued, they still have that claim. The shareholders have the residual claim to the income. So the equity section, assets minus liabilities, or in essence, the value of the company, is thought to basically be the residual claim of the stockholders, whether the decision is to issue that income or that value out in the form of dividends, or to retain it, possibly investing it back in the company to increase the value of the company, which again increases the value of the equity to the shareholders. Also a good thing, because that should increase the market value of the stock. So shareholders do not have a legal claim to the dividends. So they can't basically require that the corporation pay them a set dividend, because the corporation once again has to kind of decide what they're going to do in terms of the distribution of the dividend. So although they have that residual claim to the equity, you can't really force, at least on an individual level, the corporation to be paying that out at any given time. The corporation has to decide what is in the best interest as a whole, given the process. So a company could have several different classes of common stock outstanding that have different rights to dividends and income. So we often think about the common stock, the categorizations of the ownership are going to be a lot more defined when you're talking about a corporation as opposed to, say, a partnership or something like that. But it is possible to have different classes of the stocks out there as well, that it could have different. But whatever those classes are, again, within that class or within that category, it has to be well defined, because the idea of the stock is that it is somewhat standardized in unit. Then we have the voting rights. So if you're the owner of the corporation, then you have rights to some form of decision making. Now, again, if you're talking about a large type of corporation, then it's kind of like a republic type of situation, where you're going to vote for someone to do something, to hire someone to do something kind of thing. But you have those voting rights to do it. So generally the voting rights would be, you got the right to vote in, say, the board of directors, who then has the right to basically hire the management. So a company could have different classes of common stock with unequal voting rights. So you could have different classes of common stock. Once again, it would have to be determined or straightforward what the current classes are of the common stock. The common shareholders have the right to vote for the election of the board of directors, vote on other major issues. So if there's major issues happening, then again, they should have the right to vote there, and assign proxy or the power to cast their ballots. So they could basically, in essence, hire an agent to basically take the vote in their behalf, acting in their interest. Voting right, cumulative voting. So we could have two types of voting here. The classic type of voting is the majority voting, where the shareholder who owns more than 50% can elect all the directors. So in other words, if you're voting for the board of directors and you're voting for each individual seat, and each shareholder gets to vote for each individual seat, well, then each one is its own kind of like election, and the majority, if someone has over 50%, the majority will basically win in those cases. Now, cumulative voting is going to be a bit different, where you can kind of consolidate your votes, and it's usually described as a way that minority interests, people that have less than 50%, may be able to get more people on the board, even though they don't have that controlling interest. So cumulative voting, shareholders with less than 50% may still elect some of the directors. It can be a little bit complex on how the cumulative voting works. Best way to understand the cumulative voting is to work practice problems. So if you think about an election process for the board of directors, remember you're thinking about a situation where there's going to be so many people on the board that basically have even kind of authority on the board to make votes or decisions, on once they are on the board. So it's not like you're voting people on the board that have a different hierarchy position. In that type of situation, then we might have a situation, then instead of voting for each individual member, we can say, why don't we, tally up the votes that would be applicable and allow people then to consolidate their votes and use more of their votes to consolidate on one particular person, for example. And by streamlining their votes, the minority shareholders then have more power and can possibly get some more sway on the board than if you were having an up and down vote or a vote on just each individual seat. That's going to be the general idea. Now, once you have this set up, there's actually some formulas that you can think about how many seats you can get on the board. There's typically two questions that you could ask, and if you have a cumulative voting situation. And note, the typical way we see this in the corporate setting, corporate finance, would be the election of the board of directors. But you can see this in other type of election processes, whether it be governmental type of election processes or not-for-profit type of election processes. Anytime a thing where you're electing like a board to vote on something or make some type of determination, and they're all kind of even on the board, right? And you're electing these members, you could have this cumulative type of structure, and it's a common system to have. If you have that situation, there's two things that you might ask yourself. You might ask yourself, well, how many shares would I need? The shares, the ownership power being shares. The shares are what grant me the voting power. So how many shares would I need in order to elect so many people onto the board? Possibly looking for a majority membership on the board, per se, so that they have more sway over decision making. So for example, if you wanted some change in management or something like that, then you might be saying, okay, I need to get a majority on the board. That would be this many people on the board. If there's 11 people on the board, you might need then 6 in order to get a decision making process done, to get a winning vote to possibly replace the current management structure. Now, the other question you might ask is, well, what are the number of directors that I can elect given the current number of shares? In other words, if we think about the current number of shares that we have, then if we consolidate our votes and maximize our votes, then how many directors are we basically guaranteed to get? Now, when you think about these two different scenarios, you're kind of doing like a game theory type of analysis, where you're trying to think about what the other person is going to do or what the other group will do. And usually the first step would be to think about, well, what would be the worst case scenario if we took this direction and the other side all got together and knew what we were doing and tried to stop us. Even in that situation, what's the best we can do? And then you could run different scenarios from there, which we will do in practice problems. So when you're looking for the shares that would be required, so you're in a situation, you're saying, okay, we want to get this many people on the board. How many shares would it be required for us to do so? The formula would be the number of directors needed, the number of directors that we want on the board, times the total number of shares outstanding, divided by the total number of directors to be elected, plus 1, and then that entire thing plus 1. Now, if we're going to take a look at and say, well, here's how many shares that we have, here's how many ownership shares we have, and we want to think about the number of directors that we can elect, we have another formula. Note, these two formulas are the same. I mean, they're related, of course. So if you having to memorize these formulas for like a book problem or something like that, realize that they are related so that you could plug in, if you're given the information and you only remember one format of these, you can plug in the information to this top formula and then solve for the unknown, for example, which would be the number of directors. But you can also just basically write it out in this format. This would be the way to write it out if you're solving for the number of directors that can be elected. If you know how many shares you have, that would be equal to the shares owned minus 1 times the total number of directors to be elected plus 1 divided by the total number of shares outstanding. So again, the best way to understand these formulas, work practice problems, we'll do many practice problems, we'll work them out, and then we'll actually think about it intuitively to think about what is actually happening. So we also have the right to purchase new shares. A corporate charter that has the preemptive right provision may require holders of common stock must be given the first option to buy new shares. So that would mean basically if you're a current stockholder and the corporation is thinking of issuing new shares because they want more capital, they want more cash, and they would like to issue shares to do so, there's a concern, of course, if you're a current stockholder and they issue shares to other people, because then that's going to dilute your voting power. Your percentage ownership is going to go down, among other things that could be possible. So to stop that from happening, to stop a decision being made that would basically issue shares that would reduce the amount of voting power, you might have a situation where you have to allow the current shareholders to purchase some of the new shares that would be issued first, and that would help in that situation. So a rule like this will prevent management from subverting the position of the present stockholders. So the stockholders can choose to sell the rights instead of exercising them. So typically what could happen in this situation is you might have then rights that are granted when they're thinking about issuing new stocks, and the current stockholders then could either exercise the rights or possibly they could actually sell the rights themselves on the market. So you kind of have these two things that are going to be taking place, and we'll talk more about this in a following presentation, this type of scenario.